Welcome to the Monday edition of Tech Stocks Daily, your go-to podcast for the latest buzz in the tech universe. Today we're diving into a legal whirlwind surrounding Telus, with 4 class action lawsuits playing out like a courtroom drama. Then we'll unravel Apple's stock conundrum as iPhone sales dip, but services shine like bright, unexpected stars in their portfolio. Plus, we're tackling CrowdStrike's rollercoaster ride through intriguing cybersecurity upgrades and a mysterious federal investigation. Finally, we'll explore the buzz around Deere Company's option market activity. Are financial sharks seeing a green horizon or just a mirage? So buckle up for a tech-packed adventure on the latest in the market chaos. Let's get started. All right, folks, buckle up because we have a whirlwind of legal jargon heading our way. Today's hot highlight in the tech world is the unfolding saga involving Telus International Inc., trading under the ticker TIXT on the NYSE. This tech giant is under legal scrutiny, along with a wave of 4 different class action lawsuits crashing over its bow faster than you can say, court is in session. Let's unpack the drama here. The buzz is all about a slew of class action lawsuits filed against Telus International. These are basically claiming that Telus played a game of smoke and mirrors with its investors by allegedly making materially false or misleading statements. There's some heavy legal language thrown here, so let's break it down for you. At the crux of these allegations, plaintiffs are saying that Telus International's shiny AI data solutions offerings came at a hidden cost. They cannibalized the higher margin services. Now, what this means in plain English is that to expand their AI capabilities, Telus apparently siphoned off resources from services that were more profitable. This allegedly caused the company's profitability to take a hit. It's like robbing Peter to pay Paul, but in the tech world. Furthermore, the complaint says that Telus' move towards AI exerted more pressure on the company's margins than initially disclosed to investors. Clearly, this was something that investors weren't too thrilled about, especially when the actual numbers and situations saw daylight. Simply put, investors think they were blindsided by not knowing the full story, leading to significant financial loss when truth had its day out. Different law firms, Rosen Law Firm, Levi & Korsinski, Holzer & Holzer, and Bernstein Liebhard, are representing various investors and sipping from the same legal teacup. Each firm has given Telus shareholders until March 31st, 2025 to hop on the lawsuit bandwagon and potentially make bank on any recovery that pops out of this courtroom roller coaster. On record, all firms are heavily marketing their decades of experience and millions they've recouped for past victims of securities fraud. The frequent flyer award here clearly goes to Rosen Law Firm. Having secured the biggest settlements against Chinese companies in history, they have scrolls of success under their belts. Let's just say these guys are veterans when it comes to the courtroom gauntlet. What's next, you might ask? Investors can choose to sign up as lead plaintiffs by the said deadline. But if legal battles aren't your cup of joe, you can sit back as an absent class member and still potentially cash in on a fair share of any winnings. So there it is. This Telus drama in the NASDAQ neighborhood is as juicy as they come, with allegations, profits, and high-stake lawsuits coiled into one grand plot. We'll be watching closely to see if the hammer of justice delivers any sweet redemption or financial reparations anytime soon for those caught in the financial crossfire. Remember, investing can be akin to the Wild West, folks. Part tech, part adventure, all risk. Hey tech enthusiasts, Apple has been making quite the splash in the news today, and not exactly for its signature pizzazz. Let's dive into why the tech giant has everybody buzzing. Apple's stock performance is under the microscope today, shining a light on some potential speed bumps in the Cupertino Titan's growth path. With a lofty price-to-earnings ratio that's giving Wall Street a neck strain from looking upward, Apple stock has been suggesting big growth expectations. However, the numbers tell a slightly different story. Recently, Apple's Q1 2025 financial results were released, and let's just say they didn't exactly drop any mic. Although the company reported $124.3 billion in revenue, that's merely a 4% year-over-year growth rate, not quite the sprightly leap investors had hoped for. In the world of tech stocks, where folks crave swift innovation and explosive growth, 4% might get about as many oohs and ahs as a car that goes from 0 to 60 in about a minute. The iPhone, Apple's golden child, is still the cash king, making up over 56% of total revenue. However, its sales have taken a tumble, declining 8% year over year. This is partly due to Apple hitting a rough patch in Greater China, its crucial overseas market. It's like dropping your phone and watching it fall in slow motion. Not the kind of excitement anyone signed up for. Amid this backdrop, Apple's debt-to-equity ratio faces scrutiny as well. Sitting comfortably in the middle compared to its top competitors, it suggests a reserved financial posture. Apple's balance of debt and equity financing shows stability, but some analysts are sounding the growth problem alarms. On a brighter note, Apple's services sector, including things like subscriptions and App Store sales, is pulling some weight. With a 14% increase, hitting $26.3 billion, it's proof that there's more to wear Apple's crown than just hardware. The Mac and iPad also charmed investors with a 16% and 15% uptick respectively. But let's be real, they're the not-so-little siblings to the iPhone's spotlight. Moreover, while everyone's throwing flashy buzzwords like artificial intelligence into the wind, Apple's tentative AI strides don't exactly look like they're going to kick into a sprint just yet. Their AI rollout, offering features that could nudge iPhone upgrades, feels more like a marathon in slippers. It's got potential, but in the speed department, we're talking more tortoise than hare. All in all, the market chatter questions whether Apple's current stock valuation matches up with its demonstrated growth and future potential. So there you have it. Apple's hitting the news this fine day due to growing concerns over whether its soaring stock value aligns with actual business performance. Eyes are peeled and ears perked on how it navigates these title challenges, and just as crucially, what comes next on Apple's innovative agenda. Stay tuned, because this is one story that's far from written. Oh folks, gather round, because it looks like CrowdStrike is putting on quite the show in the tech world today, with enough twists and turns to make a roller coaster look like a kiddie ride. First off, let's dive into the positive buzz surrounding CrowdStrike's recent upgrade to its Falcon platform. Imagine swapping out your old, lumbering typewriter for the latest speech-to-text wizardry. That's essentially what CrowdStrike did with their Falcon platform. They waved goodbye to outdated vulnerability management systems and welcomed in seamless cybersecurity. What's new, you ask? Well, they've taken their Falcon exposure management and given it a caffeine boost, expanding its AI-driven risk prioritization all the way to network devices like routers and firewalls. No more clunky standalone scanners and agents. Everything in one snazzy package, letting security teams kind of swoop in like digital superheroes dodging the pesky villains of cyber vulnerabilities. Plus, a little bonus surprise, up to 10% free asset scanning to get a taste of that sweet AI prowess. But like any good story, we've got a mysterious subplot. Cue spotlight on CrowdStrike being a trending topic in the stock market. Despite their flashy new tech, their stock has recently seen a dip, shaking its vitality a bit like some of us do on a Monday morning, down 10.9% in the past month. The word on the street is that this downtime is thanks to some earnings estimates taking a nosedive. The projections for their next earnings report show they'd make less moolah per share compared to last year. Oops, not exactly the fairy tale ending they'd hoped for. But wait, adding even more intrigue, we've got a federal investigation thrown into the mix, unraveling around a head-scratching $32 million deal with Carasoft technology that resembles a Hollywood plot twist. Turns out, the IRS was supposed to get some cybersecurity gear from this deal, but surprise, there was allegedly no gear. Talk about a phantom transaction. The investigation's digging into whether we've got some misleading revenue recognition tomfoolery here. Naturally, just as with magic tricks going wrong on stage, such accusations have everyone holding their breath to see what comes next. Even before this whole drama unfurled, stocks like Palo Alto Networks and CyberArk were already comparing themselves in valuation terms against CrowdStrike, like contestants on a talent show hoping to be the judge's favorite. So whether you're rooting for the underdog, hoping for a triumphant comeback, or keeping your hands securely clasped over your bowl of popcorn, real-life stock drama like this makes for an unmissable episode. Stay tuned to see if CrowdStrike can climb their way back, or if this shakeup sends them tipping further down the plotline of uncertainty. Hey tech enthusiasts, today we dive into hotspots of investment excitement and ongoing struggles that define the current landscape. Our focus? Deere Company, where unusual options activity and share performance have caught investor attention. So kick back and let's see why Deere is buzzing today. First up, let's talk money moves. Deere has grabbed attention from whales in the investment sea, leaning bullish with hefty bids in the options market. The action comprises trades in both puts and calls with some seriously hefty sums, $525,176 in puts and $365,920 in calls over the last 30 days. Those familiar with options trading know that monitoring volume and open interest offers a glimpse into the beefy bets being placed on Deere's future, suggesting these mammoth investors foresee Deere navigating between $300 to $580 a share. So what does that forecast from analysts and market watchers spell for Deere? Well, there's a dash of optimism, even with a downgrade from an analyst over at Baird to a neutral status with a $501 price target. That tells us major market players are keeping their cards close, but potentially seeing some silver linings. Why, you ask? Because even with some analysts hedging their bets, Deere's shares have performed admirably, up 11.5% year-to-date against dips elsewhere in the industrial sectors. Despite ongoing concerns, like plummeting equipment sales and farmer preferences moving towards the second hand, Deere has overcome hurdles many others haven't. Keep your eyes on fiscal developments as numbers emerge. But you say, what's the catch? While there's buoyancy, Deere's battled challenging currents. Year-over-year decreasing sales, reduced shipment volumes, decreasing earnings forecasts, and pricing concerns. Economic headwinds complicate things further. Think steels that play into exports facing tariff troubles, plus shifts in raw crop prices that dictate new equipment demand. Moreover, cost-cutting strategies and an anticipated 15 to 20% drop in key segment sales spotlight market uncertainties. Die delivers the cherry on top for my vagabond statisticians out there. A sector-forward price-earnings ratio that leaves Deere pegged slightly on the pricier side compared to its peers. Of course, there's a long grass horizon future time ball. Rising population demands will eventually elevate agricultural needs, with mechanization steering clearer paths for Deere. While some may hold on to their shares, savvy investors might wait in the wing for investment opportunities during Deere's possible price amends in these trimming turf eras. So, what do you think about Deere's current ride in the financial news cycle? Share your thoughts. Are these indicators worth jumping on, or do risk factors keep your portfolio at bay for now? Drop your insights in the comments. I'm eager to hear them. All right, let's talk about Apple because it's a name that gets everyone listening with bated breath. A major player in any tech stock portfolio, and today's tea is piping hot. Now, given today's updates, if I were an investor, I would consider holding my Apple stock. Here's why. The company's revenue growth, pegged at a modest 4% year over year, isn't sending investors dancing in the streets. Moreover, with iPhone sales slumping by about 8%, particularly in the lucrative Greater China market, that's a bit like seeing your favorite sports team drop the ball during finals. Concerning yet not entirely unforgivable, because you know they've got talent on the bench. That said, Apple's services are proving to be the strong and dependable student in the back of the class, seeing a solid 14% bump, while its Mac and iPad siblings hobbling along with respective upticks of 16% and 15%. This diversification beyond hardware shows promise, like finding an extra scoop of ice cream at the bottom of your bowl, unexpectedly sweet and assuring. However, the high price-to-earnings ratio hanging around Wall Street's neck like a shiny, albeit cumbersome necklace suggests caution. Does the stock price truly match up with realistic growth potential, or are those stock projections flying too close to the sun? AI developments are taking classes in the Apple University of Innovation tricks, so long as they can juice that potential a little bit harder. It feels like a slow burn rather than a wildfire, in keeping with tech trends. Of course, I'm just here to offer a snapshot. It's crucial to dive deep, analyze market trends, consider your financial goals, and consult with financial advisors. Investing is as much about research and strategy as it is gut and spirit. So take these thoughts as a starting point for your own further exploration. Study, analyze, make informed decisions, and remember, there's no substitute for due diligence. Happy investing. All right, tech fans, what a day on the market roller coaster. We've witnessed Telus shuffle through class action law scenes like a soap opera. Apple's stock trod through growing pains, while its services soared like hidden gems. Meanwhile, CrowdStrike cybersecurity jazz offered a mixed beat between upgrades and mysterious market dips, and Deere turned financial lemons into possible drinks of profit positivity. As we dissect these stocks in the ever-evolving tech symphony, remember to keep eyes on the horizon for tomorrow's chapters. If you're loving the insights, don't forget to hit like, make sure you're subscribed to keep up with the latest scoops, and definitely share the tech love with fellow enthusiasts. Join me tomorrow as we dive into another tech adventure. Stay savvy, and see you soon.